Welcome to our webinar today on investment properties and self-administered pensions. My name is Aengus Burns. I'm a partner in Grant Thornton Advisory, and I also head up Grant Thornton Pensioner Trustees Limited, where we act as trustees and registered administrators of small self-administered pensions. Today's webinar is primarily on how to purchase and hold property through a self-administered pension. But first, a bit about Grant Thornton. We're a firm now of close to 1,500 employees with office locations all around the island of Ireland. In terms of investing in and purchasing investment property, there are three main routes that are popular in Ireland. The first route is buying investment property personally. Some of the downsides to buying investment personally from a tax perspective is that there is tax on taking cash and resources from an employment, from a company, from a trade, and using those post-tax monies to invest in property. Once the property is purchased, again, there is tax on the income and further taxes on any capital gains of the property. So very much a post-tax existence and post-tax investing. We all know that capital allowances that were prevalent in years previous are much reduced now. So buying investment property personally has significant downsides and can be very difficult for individuals to embark on building property portfolios in their own name. More popular recently in particular has been purchasing property through companies, propcos or SPVs. One of the reasons for this is that where investors generate their cash from trading companies, there is the possibility then to use cash in the same trading company or in a group structure related to the trading company to purchase property. Of course, by so doing, there is limited or no exit tax on extracting the cash from the company or the group, and therefore there is more resources, more cash available to invest in property. However, there continues to be taxation on income and gains in the company, albeit income is taxed at the lower corporation tax rate, 25%, with further taxes on through a close company surcharge for undistributed income. There are two hits to capital gains tax, one in the company and one deferred at the point where there's a liquidation of the company. And at that point of any distributions from the company, there would of course be taxation on the shareholders, either from income tax or capital gains tax. With regard to a pension, however, there is tax relief on contributions made by an employer to a pension trust. So there's an immediate saving on corporation tax. Secondly, there's no benefit in kind on corporate contributions into a pension trust. Therefore, the full amount of available cash can be transferred into a pension trust without deduction of income tax. And once the asset is generating income in the pension trust, there is no income tax or corporation tax on the income. Likewise, there is no capital gains tax on the gains as long as the asset and investments are in the pension trust. The assets value are subject to a standard fund threshold of €2 million, which is a lifetime limit per individual small self-administered pension. However, on retirement, assets can be transferred into an approved retirement fund, or ARF, which continues to grow tax-free well into retirement and up to the date that you decease. So essentially, monies are put into a small self-administered pension, but distributions can be made out of an approved retirement fund, which is post-retirement. These distributions are taxed, but you may avail of a tax-free lump sum on retirement, which is a very tax-efficient way to extract cash from an approved retirement fund. In terms of pension property investments, standard pensions through life companies are somewhat limited in terms of the choice of funds that can be availed of to invest in property, generally exchange traded funds or REITs. And as mentioned, there is a restriction on choice available. With a small self-administered pension, however, there is open architecture, which allows direct property investment in residential and commercial properties, syndicated investment property, loan notes and other investment vehicles. It's jointly managed with the pensioner trustee, in our case, Thornton Pensioner Trustees Limited, and it is possible to borrow in the pension trust, and there is a market for debt from banks to lend on property purchases in pension trusts. We recently had IRPS 2, where there was a danger that regulations and rules would change to prohibit the use of debt or borrowing by pension vehicles. However, this legislation has not come in to date, and at this time it is unlikely to come in for the foreseeable future. There are three options for the self-administered pension vehicle. These are as a self-employed individual, through employment through a company or employed by a business, and the retirement option. In terms of the self-employed option, we would see this through a self-administered PRSA. The PRSA, however, is somewhat restricted in terms of the contributions that can be made into the self-administered PRSA. These are capped at €115,000 and a percentage based on age, so that for an investment into a PRSA, generally you may be looking at €20,000-30,000 per annum investment that can be made into a self-administered PRSA. In terms of employment, however, if contributions are made by way of corporate contributions, there is the possibility that the employer can backdate from a perspective of multiple times salary the employer contributions into the pension trust. This allows significant backfunding and much higher levels, much elevated levels of pension funding that is open to personal contributions. So often, and it's more usual, that we see the employer corporate contribution route to funding to pension trusts for property investments. On retirement, we've discussed the approved retirement fund option. So the self-administered ARF is available to receive transfers from most defined contribution pensions. Investment options are the same for all pension trust vehicles. For example, investments can be made in cash deposits, shares, funds, as well as property. So really there is wide architecture for investments in self-administered pensions. For our direct property investments, we use an exempt unit trust. This subtrust is available to small self-administered pensions, PRSAs and ARFs, so that each unit trust would hold one property with its own individual bank account. The trustees of the unit trust purchase the property and can facilitate borrowing through the exempt unit trust. Recourse in respect to the mortgage is limited to the property. No personal guarantees are allowed. And if the unit trust holds the individual property, that unit trust can be transferred in specie quite seamlessly to the approved retirement fund on retirement. Property and borrowings are segregated, and most lenders insist on the exempt unit trust to facilitate segregation of their secured asset from other assets in the pension vehicle. The key revenue restrictions on property purchases are the arm's length requirement, where you may not buy from yourself personally and transfer assets into your pension. This is extended to connected parties, where they're also captured by the arm's length rule. So arm's length transactions only. Property development is not allowed. That's to say, no buying and onward selling, akin to a trade. What we want to see in pension trusts is investment assets only. One of the real tests for an investment asset, in particular property, is whether there is rental income associated with that property. If there is rental income, it generally has the hallmarks of an investment asset. That's not to say that developments cannot be built and in turn rented out and in turn sold on. We're talking about flipping property and acting as a trade and not holding investment assets. Direct investments in private companies are limited, and the scheme must have sufficient liquid assets to provide benefits in the future. After all, these pensions are there to provide future pension benefits. Let me run through a case study with you. In this situation, we have a personal investor who generated funds of €250,000, perhaps over a number of years. By taking funds out of the company, tax at 40% income tax, and USC and PRSI was also charged and paid, so that the individual now has paid a large amount of funds generated by the company in tax and has a lower amount available for investment. In this example, in the amount of 112,500, which is a 52% tax hit, so now 48% is available for investment. The investor then moved to purchase an apartment, received a rental income. However, that rental income now is subject to tax, in this example, at the higher rate. So approximately half of the rental income is now available. In this instance, 3,240 on an amount of funds of 250,000 originally would seem to be quite a poor outcome. In the instance where the funds were transferred into a pension, there was no benefit in kind, no deduction of income tax or USC or PRSI, so the full 250,000 is available for investment. In this example, 2 apartments or 2 investments are made, whereas before just 1 was made. Twice the rental income comes in. We insist that there be a property agent to manage the property. We would also recommend that any property investor use a property agent due to the enhanced RTB and tenant legislation that surrounds us now. Also, we have our trustee fee as part of the pension trust. However, in this example, because twice the funds were available to invest and because twice the rent was coming in as a result, we're ending up with 4 times as much net amount available to the investor, purely as a result of a lack of income tax through the process. Let's look at a situation where debt is involved in the property purchase. So from a personal stake, the 112,500 after tax income, so 52% had originally been paid, 112,500 now available, and the investor goes to borrow monies in the market. Let's say they borrowed 55%, so now they're back up to the 250,000, albeit having borrowed most of that amount. The investor buys 2 properties. The investor has an income tax bill on the rent, but the investor is now required to repay the capital and interest to the bank, and is in a situation, unfortunately, now where the rent is not sufficient to meet the bank interest and capital repayments. It's in a deficit position in this example, akin to many investors 10 years ago who had to subsidize their property investments due to high taxation and due to bank repayments. Of course, the 3,742 in this example is to come out of after-tax income, so it's akin to twice your salary, perhaps around €7,000, to be able to subsidise this amount. You can see how less attractive the personal investment route is for commercial and residential investment property. However, to use the pension, the full 250,000 without deduction of tax available to invest, borrowing at 50% loan to value, which tends to be the loan to value offered in the market at the moment, and €500,000 available to invest. 4 apartments are purchased. Yes, there is property agent and trustee fees. However, there's no income tax. That therefore allows more cash flow and more rents available to service debt. And in this example, we have a more robust vehicle to service capital and interest bank repayments going forward. This is one of the reasons why banks like investing through pension trusts, because there's significant headroom to service debt. The revenue borrowing guidelines are no recourse to other assets, no assignment of rental income, no interest-only loans, 15-year maximum term, no refinancing of assets, so no equity release from assets. They're purely there for the purchase of the assets, and no new borrowing in the ARF. So there are some significant restrictions on lenders laid down by revenue. However, the enhanced headroom available to service debt is very attractive to lenders and very attractive to investors alike who wish to borrow. Just to run through some recent examples, this one of a portfolio investor wanted to build up a portfolio of residential investment properties. Apartments bought in the Midwest, €80,000 each. One lender has a minimum of €40,000 that they can lend. So 40,000 equity, 40,000 borrowings equal 1 apartment. Repayments of circa €350 per month. Rents of €850, €900 per month. A SAP equity from an existing pension transferred over €300,000, borrowed an additional €300,000, and as a result, now we have monthly net income available to service the debt repayments on the 7 apartments, the yield being about 10%. So here's a good example of a small portfolio of residential investment properties with an amount available in the pension, with an amount available from a lender, where a significant number of units can be serviced with debt. The next example is a syndicate example where we have a number of investors buying a multi-tenancy property. Refurbishment costs allowed and can be paid through the pension trust. Borrowed an amount of money towards the purchase of the property. Repayments of €2,000 per month. The multi-unit property generating €4,800 per month. Obviously no taxation in the exempt unit trust, and therefore significant headroom available to service the debt. 3 small self-administered pension investors invest equity of circa 285,000 into the exempt unit trust, split 40-40-20, and a yield of 9% available. So you can see that even with debt in the vehicle, the equity can grow quite fast when there's a significant yield. Should the property be sold in the future, the value of the property can be returned up to the SAP investors, and they may go again either separately or together in another syndicate should they wish. A more complex example of where 3 clients invested $1 million through their individual SAPs, similar to the last example, into an exempt unit trust. In this instance, an agreement was entered into to purchase a commercial site with planning, tenants and build contract in place, all arm's length as per the revenue rules. The site was purchased through an exempt unit trust with the 3 clients investing through their SAPs. Significant bank lending was made to the exempt unit trust to build out the development. The bank repayments to be made from rents over 7+ years and a maximum 15-year terms. When the clients reach over age 50 and the equity in their SAPs exceeds the 2 million standard fund threshold, they will have the option then of transferring the assets, i.e. the exempt unit trusts, into their individual approved retirement funds. And as we know, in the approved retirement fund, there's no restriction on the growth of the assets. So there's 3 good examples, live examples of opportunities there are through investing either a granular approach of property investments, residential or commercial, or syndicated investments, either with debt or without debt. So the purpose of this webinar is to show you how effective property investing and how popular it is to conduct property investing through pension trusts. Should you have any questions, please feel free to email me directly, and I thank you for listening today. Bye-bye.